Hi everyone, welcome to the webinar on Is It Time to Be Buying Singapore REITs? My name is Gerald, I'm the founder of Beansprout, and over today's webinar, I'll be sharing our thoughts on the Singapore REITs market. Okay, so without further ado, I'll be sharing my slides and we can actually start the webinar to understand more about whether the REITs are having a better outlook in today's environment. Okay, before we start the usual disclaimers, today's sharing is for information purposes only and should not be taken to be financial advice. Okay, if you are not familiar with Beansprout, we are a financial platform that provides insights to help you make better decisions. You can find more information about the REITs on our website at growbeansprout.com, or you can visit our different social media channels. Okay, so a few things that I wanted to go through tonight. The first is, number one, a quick market update. We have seen a lot of volatility in the market over the past week. So before we go into the REITs, I thought it might be worthwhile just doing a quick recap around what is driving the market volatility. Okay, thereafter, we will take a look as to the outlook of Singapore REITs by looking at the individual REIT subsectors. And last but not least, we will go into some explanation about some of the things that I'll be keeping a lookout for to understand what are the share price drivers of the Singapore REITs. Okay, so first and foremost, we start with a quick market update. We have seen the S&P 500 Singapore stocks, some of the REITs having quite a bit of share price movements over the past week. So what many of you might have in mind is what is actually driving this big share price movements. Okay, first and foremost, we start with the US. It is a very big economy. It would typically drive a lot of the movements in the global financial markets. So the data point that came out was the US employment data. Okay, for the month of July, we saw that the US non-farm payrolls just increased by about 114,000. And if you were to look at this chart here, that is significantly lower than the growth in the jobs in the month of June as well as in May. So what this actually indicated to investors is that we are seeing some signs of weakness in the US labor market. And together with that, there are growing fears about a potential US recession. Okay, and what also surprised the market was an increase in the US unemployment rate. Okay, so if you look at this chart, which shows the US unemployment rate, the unemployment rate rose to 4.3% in July compared to 4.1% in June. Okay, so that was something that reinforced investors' perception that the labor market is weakening and that maybe because the US Federal Reserve has kept the interest rates high for an extended period of time, that has actually led to a slowdown in spending, both by consumers as well as companies. And all of that is driving weakness in the labor market now. Okay, so what does that actually mean? We have actually seen a very sharp fall in US government bond yields. Okay, for many of you who might be investors in T-bills, Singapore savings bonds, you probably have noticed that the yields on these different instruments have fallen over the past few months. Okay, but what we see here is actually a very sharp fall in the last few weeks in the US 10-year government bond yield. Okay, now it is at about the 3.8% level. Okay, just about 2 weeks ago, it was still at above 4%, in fact, close to 4.3%. And if I rewind it to just even a few months earlier, in May this year, the US 10-year government bond yield was close to 4.7%. Okay, so within about 3 months, we have seen the US government bond yield falling from 4.7% to 3.8%, which represents close to 100 basis points or 1 percentage point decline over a very short period of time. Okay, but more importantly, we see this very sharp decline over the last 2 weeks, especially after the US labor data came out, which led to concerns about a potential US recession. Okay, I think together with that, you probably have read a lot of news around the Japanese stock market having a very sharp correction. We saw the Nikkei 225 falling by more than 10% in a single day, which represented the sharpest decline since 1987. And if we were to look at the 2-day decline that the Nikkei 225 actually saw, that was actually the steepest decline in a very long period of time. Okay, so you might be wondering, okay, we saw the US jobs data that came out, but what has it actually got to do with Japan? So at this point, I wanted to share a bit more about this concept called the carry trade and how does that actually affect global financial markets. Okay, so what we have seen some investors and traders doing is that because there are some currencies which actually have got the country's interest rate at a fairly low level. Okay, so the Japanese yen would be one example, given that interest rates in Japan have been very low. So what some traders have been doing is that they have been borrowing yen, given that the interest rates in Japan have been at a very low level. Okay, and what they have then done is to then convert this into currencies, which allow them to earn a higher yield. Okay, so the US dollar would be one example, especially given that the US Federal Reserve has raised interest rates very significantly over the past 2 years. And as we saw in the US government bond yields, they have been fairly elevated until the middle of this year. Okay, so effectively after converting the Japanese yen to US dollar, they are then able to earn a higher yield in some of these currencies with higher interest rates, such as the US dollar. Okay, so this is what some traders have been doing, borrowing yen given that the Japanese interest rate is low, converting it into the US dollar given that the US interest rates are fairly high. Okay, but what has changed is that the Bank of Japan has started raising interest rates. Okay, they did it for the first time about a month ago, and just last week they raised the interest rates again. Okay, so this is in opposite of what the expectations of the US Federal Reserve is expected to do. Okay, so on one hand, you have growing expectations that the US Fed is going to be cutting interest rates. And then on the other hand, you've got the Bank of Japan raising interest rates. And given what we have seen in terms of the carry trade earlier, what this means is that for some of the traders or investors that had previously borrowed in Japanese yen, they might want to unwind this trade because this trade might not be so favorable as in the past. Okay, so what happens when this trade actually unwinds? We see that the Japanese yen has strengthened very significantly versus the US dollar. Okay, for many of us who like visiting Japan, you probably have noticed that the Japanese yen has been very weak over the past few years. Okay, so that is beneficial for us who are visiting Japan for a holiday. But if you are checking the exchange rate over the past week, you have probably noticed that the Japanese yen has strengthened quite a bit, and all of it is linked to the unwinding of the carry trade, where investors are effectively converting back to Japanese yen, given the expectations that the US Fed will start to cut interest rates, and at the same time, the Bank of Japan may raise interest rates further. Okay, so in a nutshell, that is what is driving the movements in the market. What we have seen is that because of the weak US economic data, there is growing confidence that the Fed will start to cut interest rates shortly. At the same time, Bank of Japan has been raising interest rates, and that is driving a lot of share price movements across different asset classes as well as markets. Okay, so with this as a backdrop, we want to understand how does that affect Singapore REITs, how are the fundamentals of Singapore REITs like, and whether we will then find an opportunity to pick up some of this bargain in Singapore REITs. Okay, so what we have seen in terms of the movements of the REITs is that all of them have actually seen weakness year to date. Okay, that is because interest rates still remain fairly elevated, which has impacted the distributions of the Singapore REITs because of the fact that they incur higher borrowing expense with the higher interest rates. Okay, if you want a recap around why that is the case, you can refer to our previous webinar where we shared how higher interest rates actually affect the Singapore REITs. Okay, so they have actually fallen in varying degrees. We see here that REITs with US office assets have actually seen the greatest declines, given that some of them have actually suspended their distributions. Okay. What we see here is that there are some of the REITs that are seen to be a bit more resilient, such as the REITs with Singapore retail assets. Some of the healthcare and data center REITs have been fairly resilient as well. Okay, so they have actually had varying performance so far this year, but generally we see the trend that their share prices have come down as interest rates remain elevated. Okay, so thereafter, what we are going to find out is how the outlook for each of the different REIT subsectors is at this point in time, and whether that would be something that can improve, that can help to support the share prices of the Singapore REITs. Okay, so I shared earlier that one of the reasons for the weakness in the Singapore REITs is because interest rates have been elevated. We see here that the Singapore interest rates, as measured by 𝗲𝘅, has actually gone up. If you are a homeowner with a mortgage, you'll probably be aware of this, where the interest rates have gone up sharply since 2022. So that is something that has actually affected the distributions of Singapore REITs. Okay, but maybe just to put it in perspective, if I were to look at some of the interest rate changes, even for some of the markets which have started to see some cuts in interest rates, like in Europe, okay, even with the cuts, they are still at levels which are way higher than where they were from the 2015 to 2021 period. Okay, so what this generally means is that even if interest rates are going to be cut, what we have seen so far is that they are not being cut very aggressively, which means that we still have to understand the fundamentals of the REITs and whether they are able to earn a higher rental income to be able to offset this elevated interest rate environment that we are in. Okay, so we start with the first REIT subsector that is closer to what many of us can touch and feel and see on a day-to-day basis. Okay, so we start with the retail subsector, and linked to this would be your shopping malls. So what we have seen for retail sales in Singapore, this is the indicator that I would track to understand how the retail malls are doing. Okay. So generally, we have seen a weakening trend over the past few months. There was a bit of a spike in February, but that was because of the Lunar New Year. But thereafter, it has actually been on a fairly weak trend. Okay, so you might be wondering, why is that the case? Part of it is because of the fact that you have got fairly high inflation levels. So consumers are still cutting back on their spending. And then at the same time, a lot of the recovery in tourist arrivals last year is not actually sustaining at such a high pace this year. So as a result, we see that the retail sales is actually starting to weaken. Okay, so I mentioned the tourist arrival numbers earlier. If you follow the hospitality sector, this is a metric that I'll be tracking very closely. Okay, so the blue column here shows the change compared to the previous year. in the Singapore visitor arrival numbers. The red line shows the absolute total number of visitor arrivals. And what we see here is that after reaching a short-term high in the month of March, it has actually started to decline over the past few months. Okay. For those of you who have got very short memories, can't recall what actually happened in March. That was the Taylor Swift concert that happened in Singapore, which actually led to this bump in your visitor arrival numbers. Okay. But after that, we have started to see a decline in the absolute numbers as well as the year-on-year growth in the tourist arrival numbers, such that in the month of June, we are just seeing a 10% increase compared to the previous year. Okay, so with the slowdown in the tourist arrival growth numbers, we are starting to see some slowdown in the hotel revenue per average room, as well as their occupancy rates as well. Okay, so the red line shows the occupancy rate. So of all the hotel stock in Singapore, what percentage is actually being occupied? Okay, so that has actually come down compared to the March levels. The RevPAR also takes into consideration the average room rate. So it's a combination of your occupancy rate and your average room rate. And what we see here is that the revenue per available room, effectively, it has actually come down in the month of May compared to the previous few months. Okay, so some signs of slowdown in the hospitality sector as well. So that may actually affect some of the REITs with Singapore hospitality assets. Okay, next we move to office, which is one sector that quite a number of REITs have got exposure to. For those of you who work in the CBD area, it might be something that you also keep a lookout for to see whether there's a very high demand for office space in Singapore. Okay, so what we see here in terms of the office market is that while we have seen fairly strong office rents over the past few quarters, if I were to look forward to expect what might happen in the second half of this year, one thing to keep a lookout for is that there is a fairly high pipeline of office space that is coming up, amounting to about 209,000 square meters. Okay, so that is something that we need to be aware of in terms of how that can potentially dampen office rents as this office space are actually completed. Okay, so thereafter it will ease in 2025, 2026, but we need to get over this significant supply that is coming up in the second half of this year. Okay. Okay, next we go to industrial. This is where we have seen that within certain subsegments within the industrial space, there's been fairly strong demand. Okay, so this is particularly for logistics and warehouses. Okay, so if you were to look at warehouse, which is the light blue line at the top, the occupancy rate has remained above 90%. And if you were to look at some of the multi-user factory, so that is one segment where the occupancy rate has remained fairly high. Okay, but within the industrial space, there's one subsegment that hasn't been doing as well. Okay, this is business parks, where you see that the occupancy has actually come off from about 85% in the first quarter of 2022 to now below 80%. Okay, so that will affect the REITs with business park exposure, given the fall in occupancy rate within this subsegment. But for those which have got exposure towards logistics and warehouses in Singapore, the occupancy rate has actually still remained fairly high. Okay, so how does that actually affect the rents that these different REITs have been able to enjoy? We see this trend where the rents across different subsectors has moved broadly in terms of the demand trends that we highlighted earlier. Okay, so business parks, which is once again this purple line, given the weakness in the demand, the rents have actually come off in the most recent quarter. And then if I were to look at some of the subsectors where we mentioned the demand is fairly strong, such as warehouses as well as logistics, they have continued to stay positive. Okay, just another thing to highlight for the industrial market is that once again, it is one area where the supply is going to be fairly significant going to 2025. So that's something that we need to be mindful about. So while the demand has been holding up fairly well so far, we need to be mindful of the supply that's coming on in 2025. And that actually amounts to about 1.7 million square meters in 2025. Okay. Okay, so we have covered some of the key subsectors within the Singapore market. As all of us know, some of the REITs have got exposure in foreign markets as well. And I just wanted to touch on one of the key foreign market, which is China, because we do get a lot of questions about whether it is time to be looking at REITs with China assets, given that they are at fairly depressed valuation. Okay. So just one point to take note of is that the retail sales in China is still fairly weak. Okay, while it's picked up just slightly from early this year, but overall we see that they are still at fairly low levels, and that is because the consumer sentiment in China is still very weak. Okay, so we see this in terms of the consumer price index as well, where both across the consumer price index as well as producer price index, there has been fairly weak inflation numbers that have come up over the past 6 months. Okay, so that is something that we'll continue to keep a lookout for, because what this actually represents is that because of the weak consumer demand, generally we see that there is very weak inflation pressure because the retail sales is very weak, and hence that is something that will feed through to what the REITs with China assets will likely face in terms of the demand. Okay, just another point to note for the REITs with overseas assets is that the currency for most of them have actually weakened against the Singapore dollar. Okay, so while this is good for us who are looking to buy things in JB, buy things in Japan, but what this means for us as REIT holders is that for the REITs with overseas assets, we are going to see that they may have distribution pressure, as some of these rents that are collected in their overseas assets get translated back to the Singapore dollar. It may not be worth as much compared to 12 months ago or 2 years ago. Okay, so that is something that we'll continue to keep a lookout for as to whether the Sing dollar continues to strengthen against some of these regional currencies. Okay. Year to date, we have seen that this is probably the most significant for, say, the rupiah, the Australian dollar. While on the other hand, we have seen some of the currencies such as the Malaysian ringgit actually starting to strengthen versus the Singapore dollar. Okay, so with that as a backdrop, the key question that many of you would now have would be, okay, so we have seen the rising expectations of the US cutting interest rates. We have actually seen the outlook for some of the different REIT subsectors, where generally they are facing some form of headwind or another, whether is it because of weak demand or because of supply that is coming up. So then what do we do with the Singapore REITs? Okay, so first and foremost, we can take a look at the valuation of the Singapore REITs. Okay, the good thing is that the price to book valuation of the Singapore REITs are actually at fairly low levels. So what this indicates to me is that they may have priced in some of these headwinds that we discussed, whether is it in the form of the slower demand, increase in supply, or the elevated interest rates, okay? So if we look across the board and basing the valuation on the price to book multiple of the different REIT subsectors, US office REITs are trading at the most discount to their book value at just about 0.3 times. Next, we have got hospitality REITs at about 0.6 times. Then we have got the Singapore office REITs at about 0.65 times, okay? On the other hand, you've got some of the sectors that are typically seen to be more resilient, such as the healthcare REITs at about 1.2 times price to book, or some of the more favorable REIT subsectors, such as data centers, with about 1.2 times price to book valuation. Okay. Given the fairly resilient performance of the industrial subsegment, we have seen that some of the industrial REITs are also trading at fairly close to book valuation at about 0.93 times price to book on average. Okay, so with that, we see that the dividend yield offered by different REIT subsectors would actually differ fairly significantly. Okay, on average, they are still offering a dividend yield of about 6%. Okay, but we see that, say, for some of the REITs with US office assets, above 15% dividend yield. We see that for hospitality REITs, above 7% as well. REITs with China retail assets, above 7% as well. And then when we come to some of the, once again, REITs that are seen to have more favorable drivers like healthcare and data centers, then the REITs being, the dividend yield being offered may not be as high. Okay, so with that in mind, what are some of the key things that I'll keep a lookout for? Given the whole backdrop around interest rates that we have discussed, one of the key things to definitely keep a lookout for will be whether the US Federal Reserve were to really cut interest rates in September. Okay, so one tool that I find very useful to keep tracking is actually the CME Fed Watch tool. Okay, so I have extracted a screenshot from the CME Fed Watch tool. What this actually indicates to me will be the probability that traders have assigned towards rate cuts in the upcoming Federal Reserve meetings. Okay, so from what we see here, in the month of September, that is the next Federal Reserve meeting that is coming up. There is more than 60% probability that the Fed may cut interest rates by 0.5% to 4.75 to 5%. Okay, so what is interesting to me is that not only are investors expecting the Fed to cut interest rates in September, they're expecting them to cut by 50 basis points or 0.5% in a fairly sizable move in the next Fed meeting. Okay. Then thereafter, we might see another rate cut in November and then potentially another rate cut in December, such that by the end of this year, we might see that the Fed benchmark rate might potentially be 1 percentage point or 100 basis points below where it currently is, which is at the 5.25 to 5.5% level. Okay, so from what I observed, this chart always changes quite a bit. Because there can be new economic data points that come out, like what we have seen over the past few weeks, that led to significant changes around investors' interest rate expectations. So to continue keeping a lookout as to whether the Fed will really cut interest rates in September, whether they will cut by 0.25% or 0.5%, you can actually follow the CME Fed Watch tool to understand latest expectations on interest rate cuts. Okay, when you go to the CME Fed Watch tool, what is important to note is not just what is the current expectation, but also how is that changing. Okay, so earlier I mentioned that the expectations of the September meeting has changed significantly just in the past 1 week alone. Okay, so prior to the US job data that came out, we saw that investors were largely expecting that we will see a 0.25% interest rate cut in September, which will bring the benchmark rate to 5% to 5.25%. Okay, so we see this more than 80% probability just 1 week ago. Okay, but after the jobs data came out, we saw that the probability of a 25 basis point rate cut came down, but the probability of a 0.5 percentage point rate cut actually increased. Okay, so that's where we are now, where the probability of a sharper rate cut has actually came through over the past week. And that is something that we will continue to keep a lookout for around how interest rate expectations changing with the latest economic data that is coming out. Okay, so once again, if you want to keep track of it before our next webinar, if you see any major economic data point that's coming out, you can once again go to this URL with the QR code that is here and get the latest expectations on interest rates. Okay, so if our expectations is for the interest rates to be coming down, and if our idea is, okay, then it might be interesting to start thinking about which REITs to be buying. How do we then select which REIT might potentially be the best one for our portfolio? Okay, so if I expect that interest rates are going to be cut, the next thing that I will do is to start screening for REITs using a REIT screener, from which we are then able to find some of the more interesting REITs that we can do more work on. Okay, so with that, I'm going to show you our Beansprout REIT screener tool, where you can then look for some of these REITs using different metrics that might appeal to you. Okay, so I'm going to go through how this REIT screener works at this point in time and show some examples around how I will then use that to screen for Singapore REITs. Okay, so you can go to the Beansprout website at growbeansprout.com. We have that under the tools where you can then search for the best Singapore REITs. Okay, so there are the entire list of Singapore REITs that are here. The data is updated on a regular basis. And what you can find here will be different metrics such as the latest price, consensus share price target, the potential upside or downside to the consensus share price target. Okay, the latest dividend yield, the price to book valuation, the gearing ratio, the 1-year return, as well as which REIT subsector this REIT actually belongs to. Okay, so depending on what you think are some of the interesting metrics to be comparing, for some of you, you might actually want to look at maybe which are the REITs with the lowest price to book valuation, in which OUE REIT actually come out as the top. Or maybe you want to look for which REITs offer the highest upside to the consensus share price target. Okay, so if I were to do this, I can then sort by the REITs that offer the highest upside to the consensus share price target. And maybe from this list, I would then narrow down to one sector where maybe I have greater optimism around the outlook of the sector. Okay, so given the backdrop that I discussed earlier, the retail sales is fairly weak. We see that actually hospitality might also be facing some headwinds. Industrial might see greater supply in 2025. So it seems like that the outlook for some of these REIT sectors may not be so strong. And maybe with that in mind, I might want to start looking at REITs that are deemed to be fairly diversified or are seen to be very large in terms of their asset base, such that because of this, they might be able to withstand some of these headwinds by having a diversified portfolio that allow them to actually withstand some of these headwinds. Okay, so maybe if I go down this list, I will then look at the sector and maybe I look at the REITs that are in the large cap sector. And these are the REITs which might be in the Straits Times Index, which might actually represent that they have a fairly high market cap as well as a fairly large asset base. Okay, so maybe I come down this list. I see Mapletree Logistics Trust. I see Fraser's Logistics and Commercial Trust as some of these names that have got fairly significant potential upside to the consensus share price target, and within the large cap REIT subsector. Okay, so with that, I'll go into Mapletree Logistics Trust to maybe take a further look. Okay, so once you are in this stock page, you have the latest data on Mapletree Logistics Trust, including some of the recent developments in terms of the dividend announcement, their results highlights. Okay, but what I wanted to go through in a bit more detail is around this checklist, where I will then be able to do further work around the REIT and understand whether it ticks the boxes as to a REIT that I want to be adding to my watch list, and monitoring as to whether the share price is then attractive enough for me to buy into the REIT. Okay, so you might be wondering, how does this REIT checklist work? So I'm going to share with you some of what are the metrics that we have included in this checklist and how that will guide my principles as to selecting the best REIT for my portfolio. Okay, so I'm going back to the slides. Okay, so I've gone through the REIT screener earlier. To access the REIT screener, you can go to the Beansprout website or by scanning this QR code. Okay, next we come to the Beansprout REIT checklist, a very simple way to identify REITs that might be suitable for your portfolio. And there are three key things that I will look out for when deciding which REIT to buy. Okay, the first is fundamental strength. We want a REIT with good fundamentals, having property assets that can actually support the dividend payout. Two, we want a REIT with good financial strength. So effectively, the balance sheet is actually strong. It doesn't have too much borrowing, and that will ensure that it can stay resilient in different market conditions. Okay. Three is valuation, because it can be a REIT with good fundamentals and good financial strength, but already very expensive in terms of the valuation. And that may actually mean that we may not get a lot of upside if we were to buy into the REIT. Okay, so we want to make sure that the valuation of the REIT that we are buying into is attractive, so that it can actually provide us with upside when buying into the REIT. Okay, so when looking at fundamental strength, what are some of the key things to keep a lookout for? I'll be looking at the quality of the sponsor and management. Okay, so this is important because we want to make sure that it is a sponsor that is committed to the REIT, and that the interests of the sponsor, the management team, as well as the unit holders are actually aligned. Okay, so that is one thing that I'll keep a lookout for. Next will be the occupancy rate of the REIT portfolio. Okay, because we want the REIT to be able to enjoy a high occupancy rate for the portfolio, and ideally the occupancy rate should be improving such that that will lead to higher distributions for us as unit holders going forward. Okay, the next thing I'll keep a lookout for will be this thing called the net property income yield. Okay, which is effectively how much income the REIT is able to generate from its portfolio versus the market value of all of these assets. Okay, so ideally we'll want the yield to be high such that the REIT is then being able to get a good income that they can then pay to us as unit holders. Okay, next we come to financial strength, which is all about the balance sheet of the REIT. Okay, so relating to this, we want the gearing ratio to not be too high. Okay, because what this means is that there is actually some headroom for the REIT before they meet the regulatory requirement on the gearing ratio. It means that they can potentially make acquisitions. It means that we do not have to be worried about whether they are able to get the support from the banks in some of their activities. Okay, so definitely keep a very close lookout for the borrowing levels of the REIT as reflected in the gearing ratio. Next, we want the REIT to be able to support their interest payments with the income that it is generating, and this reflected in the interest coverage ratio. Okay, so we want the interest coverage ratio of the REIT to be high. Next, we want the REIT to be able to grow its book value. Okay, because what this means is that we have more certainty around the book value of the REIT. It is something that is growing. We do not have to be worried that we will see an erosion in the book value over time. Okay, last but not least is valuation. We want it to offer us a good dividend yield to compensate us for the risk that we are taking in buying this REIT over relatively safer assets such as your T-bills or government bonds. Okay, so the dividend yield must be attractive to me and provide me with a good income. Okay, we would ideally want the distribution per unit to be growing such that over time we are able to get a higher distribution. And last but not least, we shared the price to book valuation earlier. We want the price to book valuation to be attractive such that we are not overpaying for the assets of this REITs. Okay, so to recap, number 1, fundamental strength, number 2, financial strength, and number 3, valuation. Okay, so with that, I'll go back to the REIT checklist on the Beansprout webpage, where we can then look at how the REITs perform on this checklist. Okay. Okay, so going back to Mapletree Logistics Trust, since we have used the REIT screener to actually identify that, okay, maybe this is a REIT with a decent upside to consensus share price target. It is deemed to be a large cap REIT, which means that it has got a fairly large asset base. Okay, and then we can look at each of these checklists in detail to understand what are the good points as well as things that we need to be cautious about relating to the REIT. Okay, so if I go through for Mapletree Logistics Trust, what is positive is that the interest coverage ratio is at 3.1 times. Okay, so that is fairly decent. It is above the regulatory limit, and that gives us some comfort that it's able to pay off its interest expenses using the income that is generated. Okay. The dividend yield for Mapletree Logistics Trust is fairly attractive as well, 7.1%, which is above the average for the large cap Singapore REITs. And if I were to look at the price to book valuation, below 1 times at 0.92 times, which is once again below the sector average. Okay, so there are some plus points for Mapletree Logistics Trust, but then maybe there are some things that I would then have to keep a lookout for. One of which is this decline in net book value from 144 in the previous year to $1.38. Okay, so maybe we'll want to look out for whether the net book value actually stabilizes for us to gain confidence that the book value is going to be stable and that we will not see a further decline. Okay, we still saw a slight decline in the distributions of MLT compared to the previous year, not significantly, but maybe with that, we want to make sure that the distributions is growing once again, which will then provide us with confidence that, okay, while the dividend yield is 7.1% at this point in time, we will not see a very sharp cut in the distributions, such that this dividend yield might not actually eventually end up at 7.1%. Okay, so that is how I will actually look at the checklist. Okay, so with that, maybe I will realize that, okay, there are some positive for Mapletree Logistics Trust. There are some things that we have to maybe continue to keep a lookout for. Okay, you can read some of our insights relating to Mapletree Logistics Trust. This can be in the form of the update on the latest earnings of the REIT. Okay, and at the same time, if you think that, okay, this is something that I want to actually keep a closer lookout for, then what you can do is to add Mapletree Logistics Trust into your watch list. Okay, so once you add Mapletree Logistics Trust into your watch list on Beansprout, you'll be then able to track it more closely, including being able to look at the latest insight on the REIT, as well as some of the latest news, as well as being able to track some of the upcoming dividends that this stocks or REITs that you have added to your watch list actually provide you. Okay, so then you can come back and revisit the watch list and understand whether some of these metrics have actually changed. Okay, so that is the watch list. I'll go back to the REIT screener once again. Okay, because some of you may then wonder, okay, what are some of the other REITs that then come out on this REIT screener? Okay, so as I go down the list of large cap names with fairly sizable upside to the consensus share price target. Okay, so I mentioned 𝗵𝗲𝗰𝗍𝗄𝗃 Logistics Trust earlier, and then you've got some of the others like Frasers Logistics and Commercial Trust, 𝗵𝗲𝗃 Pan Asia Commercial Trust. Okay, and then you've got 𝗵𝗲𝗃 Industrial Trust as well. Okay, so maybe I'll go to 𝗵𝗲𝗃 Industrial Trust since that is something that we also get many questions on. Okay, so once again, you can go through the checklist. Okay, so what we see for 𝗵𝗲𝗃 Industrial Trust is that the occupancy rate is below the sector average. Okay, so that is in contrast to what we saw earlier for 𝗵𝗲𝗃 Logistics Trust. Dividend yield is below the sector average. The price to book is higher than the sector average. Okay, so there are some things that do not fare as well for 𝗵𝗲𝗃 Industrial Trust on this watch list. And if you want, you can also compare that to 𝗵𝗲𝗃 Logistics Trust to see how these two REITs actually compare when put side by side. Okay, so that's what I'm going to do now. I'm going to compare 𝗵𝗲𝗃 Industrial Trust with 𝗵𝗲𝗃 Logistics Trust. Okay, so by putting them side by side, you see what is the difference here in that, okay, the occupancy rate for 𝗵𝗲𝗃 Industrial Trust is actually lower than the sector average, but for 𝗵𝗲𝗃 Logistics Trust, it is actually faring slightly better. Okay, if I look at, say, valuation, then what we see here is that the dividend yield for 𝗵𝗲𝗃 Logistics Trust is higher than for 𝗵𝗲𝗃 Industrial Trust, and the price to book valuation of 𝗵𝗲𝗃 Logistics Trust is lower than what we see for 𝗵𝗲𝗃 Industrial Trust. Okay, so that's another function that we provide to allow you to compare one REIT versus the other. Okay, so with that, I'll go back to my slides and look at what else I'll keep a lookout for to choose the best REIT for my portfolio. Okay, so I've gone through the example of 𝗵𝗲𝗃 Logistics Trust using the checklist earlier. Okay, you can go to our Beansprout stock tool and be able to look at some of this checklist for yourself. The data is updated, so you'll be able to constantly compare them based on the latest updates from the company as well as the latest prices of these REITs. Okay, so after having gone through all of that, you might actually think that, oh, that sounds like a lot of work. What if I don't have the time to actually do the screening myself, actually look at this REIT checklist by myself, and then subsequently do the due diligence on each of these individual REITs before putting my hard-earned money into it, okay? So the other way to gain exposure into REITs would be through REIT ETF or exchange-traded funds, okay? So with a REIT ETF, you can get exposure to a basket of REITs with a single trade, okay? They are lower cost compared to actively managed portfolios because effectively they track a benchmark and hence there is no active management of these REITs, okay? So while they are not actively managed, they are professionally managed, and the fund manager will do the automatic rebalancing for you as well as handle the different corporate action. Okay, earlier I shared one of the key benefits of the REIT ETF is diversification, because if you are not sure which REIT might potentially do well and analyze each of the outlook of the REITs by yourself, the good thing for a REIT ETF is that with a single ETF, you can gain exposure to different REIT subsectors, whether is it retail REITs, industrial REITs, hospitality REITs, through a REIT ETF. Okay, your next question might be, okay, there are actually quite a number of REIT ETFs in the market. How do I then select the best REIT ETF? Okay, so we actually see 5 REITs ETF, okay, in the Singapore market, and all of them offer a dividend yield of above 4%. The highest one, the CSOP IHS REIT Leaders ETF, offers a dividend yield of 7.4%. Next, the Nikko AM Switch Trading Asia X Japan REIT ETF offers a dividend yield of 6.4%. Okay, but I wouldn't just be looking at the dividend yield to determine which REIT ETF to buy. There are a few other things that I'll consider as well, such as the expense ratio, the asset under management, or whether I want exposure just to REITs that are listed in Singapore or REITs with broader exposure. And if you want to look at each of these different drivers and select the best REIT ETF for yourself, you can once again go to the Beansprout website. We have this article that helps you identify some of these different metrics to keep a lookout for and choose the best REIT ETF for your portfolio. Okay, so I've shared quite a number of different things during the presentation. Number one, we looked at the macro, and what we have actually shared is that interest rates will continue to affect the price of REITs, and that is something that we will continue to keep a very close lookout for. I shared the CME FedWatch tool. That's something that we can continuously go and look at to understand what are the latest interest rate expectations. Okay, one thing to be aware of is that even if interest rates were to be cut in September, we may not see the borrowing cost of the REITs coming down immediately. And what this means is that the distributions of the REITs may continue to be impacted in 2024, even if interest rates were to be cut in September. Okay, that's because some of the REITs may already have fixed their interest rate at a fixed level, such that even if the interest rates were to be cut, they may not see the lowering borrowing costs immediately. And what this means is that the borrowing cost may only come down in 2025, and hence we will need the REIT to have also a very good operating performance to be able to support the distribution of the REIT. Okay, so with that, we went to the Beansprout REIT checklist. We want to make sure that it's got strong fundamentals in terms of having a good operating performance. We want it to have a healthy balance sheet, not having too much debt. And we want it to have an attractive valuation to make it worthwhile for us to take the risk in buying these REITs. Okay, so to be able to track some of these metrics, we shared the Beansprout REIT checklist, and that is something that you can go to our website to be able to continuously keep updated on these metrics as well. Okay, if you find that it is something that is too difficult for you to be doing because you may not have the time, then one way to also gain exposure to REITs will be through a REIT ETF to be able to get broad-based exposure towards the sector. Okay, so I've shared quite a bit during the presentation. I also shared a number of things that are available on our website. So do take the time to explore that on our website on growbeansprout.com. You can follow us on our social media channels as well on Facebook, Instagram. Do hit the subscribe button on YouTube, where we will continuously post more updates and webinars for us to keep updated on Singapore REITs as well as other investment opportunities. If you want to join our discussion on REITs or other financial instruments in the Singapore market, you can join our Telegram group and be able to find us there and ask questions relating to any financial decision that you're looking to make. So with that, I will end my presentation. I hope to see some of your questions in the comment section, and do remember to subscribe and follow us on YouTube.